All right. Well, let's just get going. Episode number 5. Five.
Man.
Hey, I don't know if you know this. Well, of course you know this because we were celebrating it this morning. We're live. As of the recording of this one, we've posted our first one.
It's awesome.
And we're out there. We're in the internet. And
no turning back now.
No turning back. We're YouTube, Spotify, Apple Podcast. So very excited about that. And, here in a couple of weeks, you'll get to hear this podcast.
Yep.
So
that's awesome.
Trying to stay ahead. If you've been following us so far, we really appreciate the support. Mm-hmm. And, we are excited to bring today's topic. It's basically how an IBC, infinite banking concept policy, is to be structured. But before we get started, I want to just break down. I want to make sure we get some ground rules.
Okay.
Real quick. And it's got nothing to do with the podcast. It's almost like 8 o'clock in the morning, and we just had a really bad storm over the night, and my daughter woke me up really early because she was scared. And if you look outside, it's really dark. You and I are both like, man, we're tired, everything. So maybe 8 o'clock mornings for recording, not the greatest.
Well, I don't know. I mean, I'm not against 8 a.m. by any means. It's just, we got to get a good night's sleep before.
8 a.m., no storms.
Yep.
Yeah. Yep. So, but yeah, it's I'm not gonna lie. Got my little drink here, sponsored by Monster. Not really. I wish, but no, I'll be drinking that. That's for sure. So let's get into it, man. So when we talk about structuring a policy for the infinite banking concept, one, we got to use a whole life.
Yep.
I mean, according to R. Nelson Nash, becoming your own banker and everything, he recommends a whole life, dividend paying whole life policy by a mutual insurance company.
Yep.
All right. And again, mutual just means they're owned by the people that
are taking out the policies.
Yeah. So they're not a stock company.
No.
Okay. So, but then from there, not every agent knows how to structure these policies.
Yep.
And a lot of them get it wrong. Probably, I would say 3, maybe 5%, if we're being generous, know anything about this at all.
Yeah, I think the trend is growing towards, but the concept is, what do I want to say? So early 80s or so is when R. Nelson Nash came up with this thought process. And I would say the trend has grown a lot. More people are hearing about this. There's more people online. So I would give caution to, if you're starting to Google, YouTube, infinite banking concept, and you've got some people out there talking, throwing out ideas, talking about particular ways to set up policy and stuff, just be wary.
Yeah.
And make sure that those people are educated as well, if that's where you're getting the information from.
Yeah.
And so, ideally there are proper ways to structure a whole life policy. And I'll say whole life because there's other permanent life insurance products that people are selling right now to go alongside this concept, and it's not going to work. And we can just share a little bit about that.
And if you read the book, Nelson, he talks about not using those types of policies because they're nothing new.
Yep.
They were alive and well when he was around.
Yep.
And he specifically said, "This is not what I've taught."
Recommend.
Yep.
Exactly.
So, most agents are going to try to sell those other policies along with this concept, and we'll get into it a little bit more. But I just say for their own benefit. It's just the commission's higher, all that kind of stuff. So, we really want to take a look at what's truly best for the client, what their needs are, everything like that. Not every policy is going to be the exact same. Somebody listening to this is not going to have the exact same structured policy as I got because my needs and my family are different than what they need, right?
Exactly. And
so that's why it's really important to reach out to us and have that conversation and so we can start asking questions.
Yep.
Right? Because if we just prescribe something without even knowing what the situation is, I mean, that's malpractice.
Yeah. So I've heard of a couple instances. Somebody, let's say, hears about the book, and they'll go to brother-in-law, they'll go to cousin, they'll go to maybe their current life insurance agent where they've bought life insurance from, and hand them the book or ask them, hey, can you structure one of these policies? And they'll say yes. And then through them exploring, maybe hearing, they'll come to me and say, hey, look at this. Is this a good policy? And I said, well, yeah, it's a great policy. Whole life insurance is a great policy. Okay, but there's nuances the way you structure that could make it better for one way of thinking, make it better for another way of thinking. But in terms of whole life, I mean, it can be an amazing policy. It just may not be the best policy if you're wanting to implement the infinite banking concept.
Yeah.
And so I've run into that more times than I should when somebody says, yeah, I can do that. Well, just verify is what I would warn before we get into this too deep.
Yeah, and I know, this whole topic kind of came up because, back in 2012, 2013, something like that, you had a couple policies, and they weren't structured the way they should be. So why don't you talk about that?
Yeah, so had a buddy that I played college football with, was an agent at a particular carrier. I won't get too much into that, but came to me, he started selling life insurance. We needed life insurance. And so, what he sold me was not a bad policy by any means. I hadn't heard of the infinite banking concept at that point. I didn't even know what the infinite banking concept was. Now, man, it's crazy to think 13, 14 years ago.
Yeah.
So what he sold me was not bad by any means. However, fast forward another 5-6 years, and I started finding out about the infinite banking concept and started looking at my policies, reviewing things. Yes, I had cash value inside those policies, of course, because I'd been paying a premium into them for multiple years at that point. The issue was they weren't structured properly for my new ideas of how I wanted to take, my family forward financially. And so they weren't structured the way that we would recommend you structuring these for IBC. One of them was a whole life policy, but we can go into the way the premiums are structured and such. It wasn't structured properly. The other one was another permanent life insurance policy, but it was what's called a VUL, or a variable universal life. What that means in real quick terms is the premium and the cash is tied to the market. And if anybody talks to you about a VUL and IBC put together, I would just completely run. Exactly. Because one, they know nothing about the concept, and you don't want to be with an agent that knows nothing with the concept or doesn't practice it themselves. And then two, they're just not educated, I would say. And so that VUL was another policy that I bought. But, I'll be honest, I was caught up in the allure of higher returns and those type of things that I was sold with this VUL. The problem with that was I lost over $20K in cash value. I could go back and look and see what that was back in 2020. Everybody knows what happened in 2020 with COVID and all those type of things. But when we're talking about IBC, your policy should not be tied to the market.
Yeah.
And when we're talking about storing capital, your savings should never go backwards. And we can get into that later on in the podcast as well. Your savings should never go backwards. And so they just weren't structured properly. Yep. So, personally, I lived through that.
And that's the thing. We talk about wealth without stress. That's the whole purpose of this podcast. And that's what I love about the way we do things now with the policies that you've helped us get in place and everything like that, is I don't have to worry about a 2020, another pandemic or anything. I know that I'm contractually guaranteed growth throughout the rest of my life.
Yes.
Right. And it'll never go backwards. And as the policy continues to grow, it gets more efficient and grows at a higher rate year over year, right? Because of compounding interest.
Yep.
So that's why we love this type of policy. Now, when it comes to structuring your policy, there's basically two sides to a whole life policy. Unless I'm wrong, you can correct me if I'm wrong. But basically, you have the death benefit, which is basically the insurance side, right? And then you have capital storage or cash value, right? And so, when it comes to these policies, we can't store 100% cash like a savings account because the IRS doesn't like that, right?
They do not like that.
They call that a MEC, or a
MEC.
modified endowment contract.
Yes.
So basically, we have to have a certain percentage, and without getting into the weeds, we'll just keep it simple.
Yep.
Have to have a certain percentage of death benefit in these policies to qualify for life insurance. So how do we want to structure these policies that we're looking to do an IBC policy with?
Yeah. So there's two parts to a premium. So if your premium's $100 a month, $1,000 a month, $10,000 a month, whatever that premium is, there's two portions of it. There's a portion called the base premium portion. This equates directly to death benefit that you're purchasing or the life insurance. The other side of it is PUAs, or paid up additions. It buys paid up additional insurance. It increases the death benefit, but what this is doing is it's giving you cash accessibility on day one. So there's a ratio, and this is going back to 1988. The IRS put together some rules in regards to you have to have a ratio of actual insurance compared to cash value. And that goes back to, you guys are welcome to go do the research in the 80s with where tax rates were. We're historically low tax rates, by the way, and we can get into those conversations too.
And that's a sad thing because we are not.
It's crazy to think, as you look back into the founding fathers, that they were throwing tea in rivers and stuff over
2%,
over 2% tax, and we don't even balk at where our taxes are now. So
we pay more than that just in the gas tax.
Yeah,
it's insane.
So okay, shut off there. But so people were storing a lot of cash in whole life policies. Of course, Uncle Sam got wind of this because once it's inside that insurance bubble, growth is non-taxable. Uncle Sam didn't like the thought of their revenue decreasing for the amount of wealthy people that are putting their money in whole life. So that's when they went back, got Congress together, came up with TAMRA, which was a revenue act that they came out with in 1988, and set these limits. Over 7 years, you have to have a certain amount of insurance compared to a certain amount of cash.
Okay.
And so within those limits, you have a non-MEC. It's a non-modified endowment contract. If you put a penny above in cash than what that ratio is, now they consider this a modified endowment contract, and you lose the tax advantages that come from whole life insurance.
From the growth, yeah.
From the growth.
Yep. So as that grows, it's this taxed and ordinary income and everything like that.
They look at it as an investment account then instead of a life insurance policy.
So something that you said kind of spurred a thought. For anybody listening, there is no such thing as a tax loophole for the rich. There's just not.
No.
And the reason I can say that is this is a prime example of the IRS and the government. If it's not in their best interest, they will shut it down.
Well, they'll try to. And so, I'll have a lot of people will set up policies, or we'll be looking at policies, looking at the thought process of a financial game plan moving forward. And because, Congress has changed laws, they've changed the government plans a lot of times, they'll just ask, well, what keeps, government or law to change this? Well, I say this is contract law. It's not a plan that the government put together. And so the steps for them to change this would be astronomical compared to them going after 401ks, qualified plans, Roth IRAs, all those type of things. That's a stroke of a pen, a vote that changes that. That's an easy one to change. And so I tell them, I would be more wary of where your money's at now in the plan that you're going on now, compared to them having to go through the courts and actually change contract law, which was in place before the IRS was even a thought in anybody's mind. Yeah. So there's protections that come in with this as well.
That's good. That's a good point to make because, you're right. I mean, this predates, the federal income tax, the IRS. I mean, it's just, it goes way back. And to change these kind of things, they didn't change the fact that this all grows tax-free, everything like that. What they changed is how much how much proportion of death benefit you have to purchase with the cash value in order for it to be considered life insurance.
Yep.
And that's all they changed.
Yep.
And there's ways that we can really dump a whole lot of cash into here without triggering a MEC, a modified endowment contract trigger, I guess. And there's some things that we can do. So let's say we do have a lot of money and we want to dump something in there. How could we do that?
Yeah. Well, so this goes back to, and we're going to talk about it a little bit, is having an individual that is educated, because there are major tax consequences that can happen. And if you want a non-modified endowment contract, we personally have systems in place and everything that checks and does those calculations and everything on the back end. So we cannot create a modified endowment contract unless we go through multiple times saying, yes, this is what we want to create. And there are times when that does make sense. And maybe we'll get into that in another episode when it comes to ways of thinking for certain individuals. But for 99.99% of my clients, that's what they want, is a non-modified endowment contract. If not, they would keep probably doing the things that they're doing.
Yeah.
And same thing with your clients. I mean, 99.99% of the time, they're wanting a non-MEC policy. There's also even safeguards in regards to if you start a non-MEC, the insurance company then checks as well that if for some reason you overdo a loan repayment or the premium for that particular year was too high, you will get in writing a form mailed to you saying, are you sure you want to make this loan repayment? Are you sure you want to make this premium deposit? Because if so, you are going to create a modified endowment contract, sign here, all these safeguards are in place.
We want to make sure that you're aware that this is now taxable stuff.
Yeah.
Yep.
And then, by the way, are you aware, again, that this is going to change everything when it comes to the way this policy is? Because it's just not that year. It's for the rest of your life and the length of that contract now that it's... So it doesn't matter what you did the previous 15 years or 20 years inside this policy. If you do it in 2025,
it can no longer go back.
It can no longer go back. There's nothing you can do. You cannot pull cash out of it again. And I mean, nothing that you can do that would allow you to go back. And so it's extremely important that you have somebody that's educated. So how we do that is, one, there's a ratio to begin with of base compared to PUAs. Now, if there is a scenario where you want additional cash put into your concept, into your banking system for various reasons that maybe you want to do that, is we have to add a set amount of death benefit for a set amount of time to allow you to be able to dump that cash in.
So that's exactly what we did with my policies, right? At least on me and Ashton. We wanted to be able to, and I believe ours was set up as a $20,000, what we call the dump in the first year, right? So I had the first whole year to get an additional $20,000 in cash value put in above my premium.
Yes.
Right? And so in order for us to do that, we took a look at that and you added what's called a term rider. So basically we bought a little bit of term, right? Death benefit, strictly renting insurance for a period of time until the base portion caught up to that. And it no longer put us into a bad situation to possibly MEC this contract.
So that did a couple things for you guys. One, it front-loaded a lot of cash for you guys to gain access to in your banking policy to go out and then use. Okay, so that was a win-win for sure. But also with the level of income that you guys were earning, you also needed just straight life insurance protection as well. If something happened to one of you. Both of you guys contribute highly to your financial situation. So if something would happen to one or the other of you guys, the other one needed to be protected. So it covered several bases. So not everybody, one, do they have the cash to sit on to be able to do what you guys did? Or two, does it make sense for them to do that? And going back to, you need to have an agent that's willing to have that conversation with you. That's what I love about what we do, is the fact that I'm a third party in all of these thought processes or all these decisions. I mean, I have no emotional tie to what you do. And so I can give honest opinions and say, hey, have you thought of this? And I can look at it from a whole different perspective because you're emotionally tied to that financial decision.
Yeah.
And just educate, and let you make a educated decision when all that's said and done.
What I loved about it is doing it the way we did is with both Ash and I in the real estate world. I mean, there were times when we had, I guess average months, and there were times when we had great months, right? And we knew that would happen. And when you do this additional dump for the first year, it was an optional thing that we could do.
Yes.
We didn't have to do it. So I had the entire year to get that extra $20,000 put in there. And if I didn't, it was no harm, no foul.
Yep. The biggest thing what this does is it creates a ceiling. And we're never going to go above that ceiling. But you can also stay below the ceiling depending on what happens that first year. But if we don't set that ceiling where we set it, then you can never exceed it because now you've created that modified endowment contract.
Yep.
So structuring is key.
And it's the same thing. So, like I said, I track every month, what my potential cash value is, minus my loans, all that kind of stuff, where I'm at, cash value wise, everything. So I know every month that ceiling that you're talking about increases because we're buying additional paid up additions, right, that increase my cash value. And so my bucket's getting bigger and bigger and bigger. Now, if I take a policy loan out, I still am able to put that cash back in there, and I have that room. And every month, that room just keeps growing and growing. Yep. So that's the cool thing about tracking, knowing exactly how much you can put. Because if I do get a big windfall of money, then I know, okay, I got room in my bucket now. I can put that back, right? So that's a great deal to go. So what makes for an ideal policy when it comes to the infinite banking concept?
One, first and foremost, it's got to be a mutual insurance company.
Okay.
So that's a quick question that you can ask whatever agent that you're out there talking to, or if you want to get a second opinion, ask. Is this a mutually owned insurance company or is this a stock-owned company? If they don't know the answer, that probably tells you maybe we should start going somewhere else. Ask them, what type of policy is this? If they can't answer that, I would say you probably need to turn away and just end the conversation. So it's got to be a whole life insurance policy. There are permanent insurance products, okay? Whole life falls inside of that. An IUL, which is a indexed universal life, falls inside of that. A VUL, which I had, and we talked about that, is a permanent insurance policy, but they are not a whole life insurance policy. There are nuances in between all three. And so it's got to be a whole life. It's got to be a mutual insurance company. It's got to be a fully funded, maxed out, non-MEC policy, ideally. You could do this concept with a fully funded policy. However, it's going to be several years before you're going to be able to really use this and have access to cash value.
Know what you mean when you say fully funded?
Fully funded would be the highest amount of cash available for that premium that you're paying into that. The highest cash available is what I would say is fully funded.
So when we talk about the two different aspects, let's say you got 100%, right, to make up the full policy. What are we talking about, like 50-50, like death benefit, insurance, and then 50-50, or the other 50 being cash, or what's kind of the ratio that you see most of the time?
Yeah, so the cash is the higher percentage. Okay. It's based on age. It's based on health. It's based on several different factors, and that's the great thing is the system helps contribute to all that. The older you are, the more base you're going to have to purchase compared to in relation to cash.
Yeah.
And so all those are set by those different avenues in that regard. In terms of a ratio, I mean, it's hard. If you give me a 25-year-old, you're looking at an 80-20 split, 80% cash value, 20% base, for example. If you're looking at a guy my age, 40s, early 40s, you're looking closer to like a third of base, 2/3 cash value. But like we mentioned, there's things we could do. If you want to up that percentage, we can do some playing around with term policy or term riders, those type of things to make that policy still a non-MEC.
Yeah, I think when we were putting mine together, we were looking at two different options. We were looking at a 70-30 split, so 70% cash value, and we looked at an 80-20 split, so 80% cash value. So why couldn't we just do, if we want to build up cash value, right, as quick as possible, why couldn't we do I've heard of 90-10, I've heard of a 95-5. Why would we not want to do that?
So you could, and you can, and there's a lot of people out there, and this is also different opinions with different agents you work with. I tell you, whenever you're looking for an agent, is this somebody that I want to do business with for the rest of my life? Or is this somebody that I would want my kids, when I pass away, to trust them to be a good steward, to my kids? And so that's another thing that you need to look at. On top of, can they structure a policy? Because each one of my clients, we're having yearly reviews, we're having discussions all the time. At least I like to have those discussions. And so that's something that you need to look at, and it's all different opinions. My opinion is yes, we're looking in the short term. We're wanting to give you cash availability if you want to implement this whole process. Yes, that's extremely important. But I'm also thinking of wealth transfer has to come into this. How does this look in 5, 10, 15, 20, 30 years in your overall financial outlook? So that's got to come into play as well.
Yeah.
And so when you start looking at even more extreme cash values in the beginning, and we talked about that term rider just very briefly, that term rider has to be at a certain level where it's almost offsetting the advantages of having all of that cash. Because at some point, when you have such a large term rider, and what a lot of agents are doing is they're doing it on a year-to-year basis. So you're the youngest you'll ever be today. You're the healthiest you're ever going to be today compared to tomorrow, right?
Let me guess. Term next year is going to be more expensive.
It will be more expensive. So,
which means my premium goes up.
Yes, for that term rider.
Yes.
Okay, not the premium that you set, but on that term rider, it is taking a little bit more of that cash value. And so, yeah, I gave you great cash accessibility year one, but don't be blinded by that in all instances. Sometimes it makes sense. Very rarely does it. Because there's also an inverse curve that at some point, the base actually starts to contribute more to cash value than the big cash dump in that we did on year one or those first 5 years, 10 years, whatever it may be.
Yeah.
So that's when I'm talking about being more long-term thinking. The wealthy are long-term thinkers. And if you're wanting to become wealthy, you also need to get out of the instant gratitude of having all this cash and maybe be more thoughtful of long-term as well.
Yeah. There's a fine line, depends on what your needs are, right? So, and I think when I'm looking at my policies and everything, I think we did a 10-year term rider on mine. So I didn't have the change. My premium is the same for 10 years.
Yes.
And then it drops, and a lot of that term, what I was paying for the term comes down, and it actually, my premium drops actually substantially. Yep. So, I can't wait until these hit 10 years because I'll have the same amount of, death benefit or even more because it's still continuing to grow and I don't have to contribute as much to it. So, when it comes to, I just hate to say it, but when it comes to most agents out there, I feel like they're just looking out for their best interest on what their commission is going to be. And when it comes to an agent getting paid, they only get paid on the insurance side of the policy, the base policy, right? Yeah. So that's why, when you hear Dave Ramsey say, oh, these whole life policies are a scam, they're just horrible and everything. Well, that's because, 95% of these policies are mostly all death benefit, very little cash value, right? And that's how Dave's able to say, oh, the return on that, you paid all this money in and you got no cash value to show for it. And well, yeah, because it's structured in a way.
Well, and that's a lie. So Dave's not, I think we've maybe talked about this. If not, I'm going to throw it out there. either Dave's straight lying on a lot of the aspects that he talks about when it comes to life insurance, or he's just not educated. And I hope it's the latter, that he's just not quite educated.
Yeah.
There's just several things. We could probably have a podcast on what he said about whole life and just educate you guys on the truth. But yeah, that he's just not educated, I hope, on a lot of those aspects.
Yeah.
So
I guess I throw this out there because you really want to find an agent that's really looking out for your best interest, right? Mm-hmm. Like you said, you want somebody that you want to do business with for the rest of your life, and it's going to be around, for your kids and everything like that. What's going to set you guys up for your family structure the best.
Yep.
And, when you're talking like the policy, I think we put in place an 80-20 for me. I mean, 20% of my premium was death benefit, the other 80. So that means your commission got cut 80%, right? And so, back when you helped me get these initially started, you looked out for the long-term play of what would be best for me and my family. And I know I asked you straight up, why would you do that? And you're like, well, I'd rather look out for you, and you're much more likely to refer business to me if you know that I'm actually looking out for your best interest. I can care less about the commission on this one. I'm looking for the long term.
Yeah.
Right. So that's how I love doing business that way. Sacrifice in the beginning, especially on your end. And not to say that, like in real estate, I didn't want to get paid, because I wanted to get paid.
Yeah.
But I also wasn't afraid to talk people out of buying a house that I thought was a bad deal, because I knew if I could be honest with people and look out for their best interest, the referrals would come. And that's what I want.
Yeah, my thinking when it comes to that is clients' goals, everything is 100%. For a lot of agents, their thought process is, make the sale. How can I, and just being honest, the majority of people, but that's also why they're at where they're at, they're literally just shopping off of price. Now, in property and casualty, some of these other avenues of insurance, I could argue that, you could get the same coverages, and so price would be the tipping point, whether or not you go with Allstate compared to State Farm, or go with the Gecko, or whoever it may be, right? However, when it comes to life insurance, you cannot base this off of price. And so, my original policies that I was given, my agent, and a lot of life agents look at this, is, okay, Jason, how much do you owe on the house? What's your yearly income? How many years of income would you want replaced if something, happened to you and you passed away? So, if it's 10 years or 20 years, our Claire at the time was 1.5 years. So, I was thinking 15, 20 years out, right, to get her off to college, or maybe start being sustainable for herself. How much did we owe on the cars? Like all these different aspects, right?
Yeah.
And we spit out a death benefit that would cover all those liabilities and things like that, the debt, all of that, help Allie be debt free. However, because you're looking at that now, to be able to keep the price down, and the base portion is wholly tied to death benefit, right? Let's say I needed $1 million in death benefit, but I wanted to get the price as low as possible. I'm going to put that entire premium towards base. So it's all paying towards the death benefit, thus lowering the price on premium to make the sale.
Yeah.
When we're sitting down with our clients, our thought process is, what is our overall financial goal? How much cash do we want to have available? How much money do we want to save? Because we're looking at this as
a place to store capital.
A place to store capital. How much capital do you have available on a monthly, yearly basis, whatever it is? How much are you already saving on a monthly, yearly basis? And instead of funneling these funds here and not getting any benefit, that's what we're going to set the premium amount to. And of that premium, we're going to max out the cash availability that we can legally, of course, that the IRS sets. We don't set that. And then at that point, a death benefit is kicked out, and that's all icing on the cake. I mean, we're creating a living benefit for you to increase cash flow, increase worth, all those type of things. And a death benefit's kicked out.
Yep.
Now, if that's not enough, there's other things that we can do from a death benefit standpoint, but also thinking is eventually we're going to get there because of the cash flow, the investments, all these different things that we're going to do with this now stored up capital. And we can then funnel that back into our system again, take out additional policies, which takes care of the death benefit. So it's very strategic in everything that we do.
Yeah. I remember coming to you when I was looking to do my second policy, because I funded initially the policy, built up some cash value and everything, and took out a policy loan. And I was, as a good banker would, I was paying myself back. And I was thinking, okay, instead of paying towards this policy, right, my cash value is growing every time I make a premium payment. Would it be more beneficial to expand our banking system and start another policy and use what I was paying back to the original policy to fund the second policy? And then we had that conversation, and we could do that. We looked at the math, and we could do that without running out of cash in the initial policy. And it still left me with a big bucket of where I could just put extra money back. And so that's when we made the decision to go ahead and start that second policy, expand our system, which gave us more cash value and everything like that. So that was a great.
Yeah. Well, that's kudos to you and Ashton. You guys have the ability and the income and all those type of things to be able to do that. The majority of people, it may take them a little bit longer time to be able to do that. But for you guys were able. You're forward thinking. That's why I love working with entrepreneurs, investors, business owners, because a lot of times they'll come up with things and I'm like, well, yeah, you can do that. I didn't think of using it in this context.
We've had that conversation.
For sure. Yeah. But I love it because I'm learning something along the way too. And so that's another aspect from an agent perspective. If you have somebody that thinks, yeah, I know it all, then I'd probably go look for another agent too, because they need to be growing and always learning and fine tuning all the time. Because I believe, if you're not moving forward, you're going backwards. Yeah. And so that would be another criteria that I would look at and ask those questions to them too.
So let's talk about what questions should I be asking, an agent if I was looking to, I guess, start a policy.
Yep. So we've gone through several of them, but just to review, what type of policy is this? And if they can't answer that, I'm never afraid to share exactly what I did, how I structured it, what the base is compared to cash, all of that. And if an agent isn't willing to do that, I'd be mindful of maybe how they're going to do business dealings later on, longer in life. I would ask them too, and I can't believe I didn't bring this up yet, do you implement the infinite banking concept yourself? I mean, really, that should maybe be like one of the top three to ask, because if they're not implementing it themselves, they're not a practitioner of it, they're probably not going to be able to help you navigate through the process yourself.
I would say that's probably my number one.
I mean, yeah, probably.
Because like you said, if they're not doing it themselves, they have no idea. And then how am I going to go to them for questions about what I read in the book when they don't even have a clue themselves?
Exactly. Going back to the book, ask them, have you read Becoming Your Own Banker? And you'll notice that a lot of agents have not. And so that would tell me, okay, then you're probably not the one that I would go to implement this strategy. Yeah. Do you even know who R. Nelson Nash is? And just ask them, do you know who R. Nelson Nash is? And if they say yes and are able to give you a little bit of information, then they've probably heard of IBC then. Ask them, do you know what a modified endowment contract is? I mean, those are pretty simple questions. How do you structure your policies? Would be another great question. And the biggest thing is are you a student of the concept? I mean, do you even know how this works? And for a lot of people, they'll hand somebody a book and say, oh yeah, I can do that. Well, okay. But if they haven't read the book already, I mean, do you really trust somebody that reads through a book one time and then allow them to create a structure and a policy and a financial whole outlook that could impact you for years to come, your kids, your grandkids? I wouldn't make that gamble.
Yeah. I know for me, what I would find important on top of all those things that you just listed is I want somebody that's willing to, one, be patient with me, two, walk me through all my different options. So I know when you were setting up my first policy, before I knew anything about all of this, right? You really sat down and said, okay, if we do this structured or type of structure, here's what you get for death benefit. And here, here's the long-term play and everything. And then if we went this way, here's the long-term play. And they are different, right? If you're doing it's very different between just a 70-30 policy and an 80-20 policy. Very different, especially when we get years out, right?
Yep.
And if we're thinking like a forester, like our Nelson Nash tells us to, and think long-term, we need to take that into consideration.
Yep.
Our initial play right at the time was we want most of our cash value, right, available to us. And so that's the route we went. Now, and talking to you more about it, we've built up cash value, so we don't need that as much. So if we were to start our 7th policy, we would probably do more death benefit and look long-term play of, the estate that we're leaving, the legacy that we're leaving. So, there's just different things that you want to think about when it comes to that.
Yep. What's
important to you and your family, not just now, but, 20, 30, 40 years from now.
Definitely.
So, I can go, there's so much that you could talk about in this, and, I don't want to really take this much longer. We can get into the weeds later, but, is there anything else that you want to talk about on this, or you feel like you got it covered?
Well, I don't know if we completely have it covered, but I think if nothing
and
else,
here comes the questions.
The thought would be at least educating somebody. Okay, you've listened to us for a few episodes now. You're thinking, hey, I want to look into this. My goal with today, and I know yours was too, was if nothing else, hopefully educate somebody just a little bit. So if they go out and start interviewing agents, whatever verbiage there you want to use, that they don't feel just completely overwhelmed and just go with the first person that they go out and talk to.
Yeah.
So, there's aspects that you need to be equipped for whenever you're starting to look through this.
I would say the most important thing, if you were brand new looking into this concept and you were wanting to start shopping policies, the very first thing you should do is pick up this book, Becoming Your Own Banker, right? Yep. We'll leave a link in the description.
Yep.
But it's only 92 pages. I read this in a day and a half, right? I'm kind of a geek when it comes to that, but that's what I did. But this is going to be the foundation. And then from there, you could be able to go out and interview whatever agent you want, and you'll know if they're full of crap or not.
Yep.
I mean, that's just the truth. So I'm excited for the next episode. So we're going to talk about the golden rule.
Yep.
Our Nelson Nash talks about it in here. The golden rule is those who have the gold make the rules. So we want to store capital, and we want to have, stuff that we can put into the market and really dictate how we're going to do things. So I can't wait to get into that one. So if you have any comments, we'd love to hear from you. Leave them in the comment section below. We'd love to answer your questions, everything like that. Leave a like, maybe subscribe.
That'd be awesome.
That'd be awesome. So, Jason, thanks again. Appreciate you coming in nice and early to co-host
for sure
this podcast.
Yeah.
So until next time, guys, we'll see you.